Dear friends, welcome to the module Understanding the Principal Taxes of Mexico. This is an explanatory video in which we will explain in depth to those who do not have much contact with the tax world on a daily basis and have doubts about how it works, which aspects should a foreign investor consider when investing, and the fundamentals of the main taxes that are paid in Mexico. We will try to address the most general doubts of those not familiar with the subject, such as what is the most convenient way for me to conduct business, what is deductible and what is not, amongst many others. They say that in life, only two things are certain: death and taxes. Here we are going to do our best to explain what it's all about and give you a good idea of how easy or difficult it is to comply with your tax obligations in a country with one of the highest administrative burdens in the world, as well as one of, if not the most, advanced control electronic system in the world. Everyone is obligated to pay taxes, and we will demonstrate how complex or simple the process is. We think it is important to emphasize this because in Mexico there are those who overpay due to ignorance of the tax law, or indeed we have come across people who believe they should not pay, or that they aid well with strategies that come to sell them from very low-level advisors or even the so-called invoice sellers. There's a lot, but the first step is to be calm and know the fundamentals and the basics of this, without the need to get into the complexities of doctrines directed only to those who know a lot of the law. From here, at least you'll take away a good conceptual map of what they contain and where to go in case you want to get more in-depth concerning these topics. Well, let's start by saying that the fiscal or tax issue in Mexico starts from the norm that regulates all of us, whether we want or not, by the simple fact of being Mexicans, and is the political constitution of the United Mexican States, which establishes in an article, the 31st section 4, that it is the obligation of Mexicans to contribute to the public expenses, both the Federation and the Federal District, now Mexico City, or CDMX, or the state of municipality in which they reside, in the proportional and equitable manner provided by the laws. And for all this, Article 73 attributes to the Congress of the Union to impose the necessary contributions to cover the budget. Nothing could be above of the Constitution. So from the outset, by the simple fact of being Mexicans or have a Mexican company, you're already obligated to contribute in a proportional and equitable manner. And a parenthesis without wanting to complicate things, when it refers to the term proportional and equitable, it refers to all the law that oblige us to pay taxes, mainly the income tax law and the value-added tax law, and there are others. By proportionality, we mean that the taxes we must pay for public expenses should not be disproportionate to the economic capacities of the individuals. In other words, I cannot make the lady in the corner store pay 70% income tax rate. No one, at least in our country, will survive with that. And by equitable, we mean that the rules must give equal treatment to taxpayers under the premise of treating equals equally. For example, this would be violated if suddenly it were incorporated in the law that those who work in government will be exempt from income tax, and those who work in private initiative not in certain concepts. Both types of taxpayers are individuals, right? What will be the difference? And believe me, this has already happened when an income tax exemption that applied only to governmental employees some time ago. Incredible. And evidently, it was declared unconstitutional. The message is that as long as this and more, because there are more, constitutional principles are respected, Congress can approve contributions or taxes. The Federal Fiscal Code regulates, let's say, general tax matters. It is the one that establishes the types of taxes that exist, the rules for paying taxes that are not specified in other provisions, the procedures that the tax authorities must follow when they audit you. All this blacklist stuff and the famous 69B, this is an article, digital stamps and their cancellations, fines, among other aspects. What are we going to rescue from the Federal Fiscal Code in this model? Let's start by saying that in addition to the provisions of the Constitution, Article 1 of this law establishes that individuals and corporations are obliged to contribute to public expenses in accordance with the respective tax laws. And only by law may a contribution be destined to a specific public expense. That is, of course, the law of expenditures, which is another tax law. And not everything are taxes. Taxes are contributions in themselves, but there are more concepts under which you could have an obligation to pay. The code itself states that contributions are classified into taxes, social security contributions, improvements contributions, for example, and duties. Taxes are the contributions established by law that must be paid by individuals and corporations when they fall under the assumptions that trigger them. There are direct and indirect taxes. An example of a direct tax, of course, is an income tax, which is levied on the income or profit of individuals, or as the very technical people call it, the taxpayers. An example of indirect taxes is a value-added tax, which is paid every time we consume something and is already included in the price. At least in Mexico. In the US, for example, it is not. But it is paid by that person who receives the payment. Then the problem starts when the shopkeeper thinks that the VAT is his and spends it, when in fact he's only a collector of the Mexican tax authorities or the Mexican Tax Administration Services, or SAT. But we will explain this better later. Social security contributions are the contributions established by law to be paid by persons who are substituted by the state in the fulfillment of obligations established by law in matters of social security, of course, or to persons who benefit in a special way from social security services provided by the same state. All of us who have been or are employees know this because we see some withholdings made by our employers fortnight by fortnight or month by month, which are contributions of this type. And just so you know, surcharges, penalties, enforcement costs, and compensations are accessory to the contributions that are part of the nature of, for example, of the latter. If, for example, you omit a tax, let's say the income tax, you will be subject to surcharges, which, if I remember correctly, the rate must be 145% per month. That is 74% per year, and to inflationary statement of the amounts that you owe, and that is at an additional rate of more or less 3 or 4%. If the tax authority review past years, it can more than double what you owe between the surcharge rate, inflation, and fines. A small parenthesis, the fines generally apply if the authority audits you and determines a tax credit. Normally, there are 50% of the omission, but if you voluntarily comply with your omission without an audit from tax authority, even if it is in the later years, there will be no fines, only surcharges and updates, for example. Residents in Mexico can be of two kinds: individuals, like you and me, and legal entities, which are companies or foundations or corporations. And I think that from the Federal Fiscal Code, that is what you really need to know. The basics. The rest are more specific rules for certain situations of what happens when the tax authority audits or other issues that are not relevant for this video. Now, let's discuss the income tax and divide it into several sections, which are mainly the sections that exist in law. The income tax law precisely tells us how and under what assumptions this tax must be paid. And as his name indicates, it is an income or a tax on income, on profits, which in certain occasions results from subtracting from income the authorized deductions. This word is key, that one has to make to reach that profit. This is the most complex and important tax in our Mexican tax system, and it is self-determinable for those who carry out business activities. But this means that whoever calculates it might be subject to a review by the tax authority or an audit, whose powers in general cover 5 fiscal years and in certain cases up to 10 years. To see if you determined it correctly, and of course, there are audits that are called, and there are audits that turn out to be a real battery, because there is a huge need for collection, and as they say, a minimum percentage of taxpayers pay most of the taxes. So instead of seeking to broaden the taxpayers' base by making it easier to understand and pay, the authorities want to squeeze even the stones to collect more from those who are already registered in the Federal Registry of Taxpayers. We said RFC in Spanish. And let's be honest, it's not only the authorities. Some taxpayers ask for invoices for everything, and they want to deduct things that have absolutely nothing to do with their business. Remember that we're talking about money. And in Mexico, unfortunately, we have an authority eager for more collection and taxpayers that have been quite cheating throughout the years. From buying invoices, in many of them to simply miscalculated things, there are good, bad, and regular ones. We have everything. Income tax law mainly addresses 3 types of taxpayers: individuals, corporations, and foreign residents. Here we're only going to deal with corporations and non-Mexican residents. Corporations, because many foreign investors enter into Mexico through the incorporation of a Mexican company. That's important. That's why we're going to do this. And we're going to see the non-residents. This law is divided into some titles, which in turn have chapters, and that with this it seeks to cover all operations made by taxpayers residing in Mexico for tax purposes. But before specifying these assumptions, we will mention something vital to understand the income tax. This tax is paid on the income obtained by residents in Mexico from anywhere in the world, regardless of whether this income is not obtained only in Mexico. This is known as the principle of worldwide income. Okay? Let's imagine that I have a payment for a service I perform in the United States of America. Okay? Then, in Mexico, I must recognize that, of course, and pay income tax on that income. If in the US I was withheld taxes, then here I see if I can credit what was withheld against my income tax in Mexico, so as not to pay double. And then we will summarize the main tax characteristics of these types of taxpayers, of course. So what if you invest through a legal entity or corporation? Let's start with legal entities, which, as we have already said, are companies, corporations, or associations. And just to clarify, in Mexico, there are no transparent or pass-through entities, as for example in the US. Not even when a payment is carried out to a foreign transparent entity or vehicle, as an LLC, for example, or an American LP. Our law does not recognize this, and just in some specific cases where a fund is investing, there are some exceptions. But a very confusing and hard to comply procedure has to be filed before the Mexican tax authorities before trying to recognize the tax transparency. But in this case, we will start specifically with those that seek to do business as an SA or DCB or a CSRL de CB, which will be the equivalent of an LLC, or a SAPI or an SC. It doesn't matter. They are all taxpayers in Mexico. The legal entities, as we said, are the companies. There can be many variations of companies. We already said SADCB, SAPIs, but in the end, they all fall under this title of law, except for foundations. We have ACES, IAPs, which are not for profit. These fall under another title of the law, but it could be considered taxpayer in certain cases, as we will see. Also, although it's not so much a tax matter, remember that in a legal entity, a group of persons, either individuals or legal entities, they associate to carry out an activity, but this legal entity, as its name says, has its own legal personality and different from its partners or shareholders. That is to say, its assets and its personality are of its own, and in principle, because there are some exemptions, they cannot touch the assets of those who own them, the UBOs, the ultimate beneficial owners. This is to say, if there is a claim against a service that was rendered, they can go against a legal entity, but not against the assets of its owners, okay? This, I repeat, we say with these with reservations, because there are more and more exemptions to this, even in tax matters. So just keep in mind that this idea of what I called, or what we call the corporate veil, which is precisely what separates your personal assets from the assets of a legal entity. Legal entities pay taxes in Mexico on their profits, which are obtained by reducing their income, the deductions in which they had to incur, and which are strictly indispensable to have generated income of the company, among many other requirements, such as bookkeeping, payment by electronic transfer or electronic means, over when you pay something over 2,000 pesos, $100, having the invoice, or CFDI as we call it in Mexico, we all, with all the requirements set for in the tax code, for example, etc., etc. If you don't comply with one of them, even if it will have been necessarily or indispensable for the authority, it is not deductible. This concept has caused a lot of controversy because, as you know, there are usually disagreements between what is necessary or strictly necessarily to generate business and what is not, between the Mexican tax authorities and the taxpayers. But fortunately, there are already many rules and precedents in this regard. For example, the courts have said that what is strictly indispensable is basically what, without those expenses, the continuity of the business itself will be in danger. Okay? So stop complicating things unnecessarily and don't deduct things that are not even relevant. In truth, for example, some friends of mine, even ask for invoices for things such as the payment of the nightclub, for example, the dry cleaning when there are only employees, gasoline for pleasure trips, for example, the supermarket, and that is where they start to make the tax authorities angry, and then they call them terrorists. I think there should be a fair play on both sides, you know? Basically, once we subtracted the deduction from income, we have to subtract the losses from previous year, if any, and the employee's profit sharing generated in the year. Now, we will go into each concept to understand it well, but in summary, once we subtract all this from the taxable income, then we obtain our tax result. And to this, we apply the 30% tax corporate rate. This is our income tax payable for the year. And it is not that 30% is paid on income, as many friends have sometimes commented to me, as a complaint, of course. In reality, it is calculated net of deductions, and although it is difficult to estimate exactly how much it's actually paid as an effective rate in Mexico, more or less the data that we have reached says that we pay around 16% of the income tax effective rate. But remember, this is at the legal entities level. Then it is necessary to pay individuals their, for example, their income salary, but it turns out that the income tax is not calculated only once a year for legal entities, but on a monthly basis through what we call provisional or advance payments, which are nothing more than payments in advance, as the name says, of what is supposed to be the annual income tax. What happens is that if the Treasury were to receive income once a year, I believe that the country will go bankrupt, perhaps. Because what do you do with your Christmas bonus, for example? Do you really save it to last the whole year, or do you spend it all in one shot? There are payments that are not made by those companies that have been in business for less than one calendar year, that have not passed the first month of December. This is because this monthly calculation in advance is calculated based on the fiscal result, or the tax result, of the previous year, or the last year in which there were profits. That is, taking into consideration how much of your income is really profit, that portion is what you are going to take to make a provisional payment or advance payment from the second year of existence. And if you think about it, just think about it, the fact that the factor already contemplates an implicit profit also necessarily contemplates deductions in which I incurred last year. Therefore, The provisional payment does not have direct deductions, but it brings a proportion that already contemplates them. That's what I already said. Last year, of course, but well, to continue, remember that the annual income tax payments are due every March of each year, except in very few cases that we'll not address right now, they are not relevant. And as of the filing of the annual tax return, April, you should already file provisional payments for that time of the year. Thus, each year when you determine your income tax, you should credit what you have already paid in your provisional or advance payments against the income tax that you have already paid, so you don't pay double. That's logical, right? And what happens if I pay more provisional or advance payments than my annual income tax? I basically have two options. Either I request for a refund, which is almost impossible in Mexico to obtain, that's for sure, or I can credit it against my future income tax payments, for example, against other advance or provisional payments in the future. Before, you could credit that income tax against your value-added tax, this is another type of tax, or any other federal tax, but this was recently prohibited and it affected many companies very hard in their cash flow. Now let's go back to taxable income, okay? Everything that represents an income in cash, in kind, that is, for example, when I am paid with the delivery of something different from cash, also in credit, etc., is income. It doesn't matter if it's an SADCB, SOPOM, SAFI, the type of company. They're the type of company does not matter at all, with a couple of exemptions, but generally people incorporate SADCB, for example. And if the business is very sophisticated or they're thinking about, for example, going public later, they could go for a SAPI. But this rule applies to all the companies, okay? There are few incomes that are not taxable, such as capital contributions, a capital increase in a company, for example, but most of them are taxable. There is even income that is taxable and that you may never see. Yes, phantom income, such as the exchange gain. If, for example, if you have dollars in a foreign accounts and you don't bring them to Mexico in the year, you have to calculate this effect, FX gains. We call this, as I said, phantom income, and it goes up to the provisional payment level. So if in 1 month, for example, you have a lot of exchange gain, you have to recognize even if the exchange gain, even if we have a loss in the future, then you have to pay taxes and recognize that favorable balance in the annual tax return. And when is the income recognized? This is a very interesting question. There are 3 moments for almost all of the companies. 1, when you issue the invoice or the CFDI. 2, when you receive an advance payment, even if it is only 1 peso. And 3, when you deliver the goods you're selling or provide the services. Okay? In other words, for example, if a company that sells cars receive a down payment of 10,000 pesos for a 300,000 pesos car, the company must recognize the income tax that is triggered in advance, in the advance payment of the month on the total amount on the sale of the car. Wow! But well, now talking about deductions, let's go to the main ones, which are the expenses that are deductible at once or at 100% and with the pure invoice expenses, wages and salaries, cost of sales, and be careful, not the purchase of merchandise. Because, for example, before 2004, to control the payment of income tax, a lot of merchandise was purchased at the end of every tax year. And the tax base, of course, was decreased. So this changed, right? And there are many other expenses. And for example, another type of deductions are the investments that one makes. And by investments, we refer to fixed assets, such as expenses in real estate, furniture, automobiles, or intangible assets, such as the payment of rights for the use, for example, of a trademark, among others. This is actually deducted differently than an expense. Here, the law obliges us to deduct only a proportion of what was spent annually. For example, if I buy a building, the law allows me only to deduct 5% of the 100% of each year, right? Each year, sorry. So the deduction will be taken over 20 years. Or if it is a computer, the law only allows me to deduct something around 30% of the value of the computer each year. So I'll take like 3.5 years to deduct this. This, of course, to avoid having big tax losses that later affect the tax collection for many years, and obviously to do basic tax planning that consists on buying many fixed assets before the end of the year and thus not paying income tax. Besides taking care of all of the requirements that must be fulfilled for a deduction, it is also important to take care of something that is a recent concept, that is to have the so-called materiality of the transactions. This has become very important. Why? Lately, the tax authorities have been very mad, with some reason, of course, because many taxpayers used to bought invoices for non-existing services in order to deduct and reduce the income tax basis. And of course, the income tax. But they did this with services that did not exist. For example, with invoices, and that's it. They have no other support. Then these amounts were returned to the individuals or owners of the company under concept that were exempt for them or that have already paid their income tax through withholdings, unexisting withholdings, of course. As of the last year, this is a criminal offense. If these types of invoices exceed a certain amount, around 7 million pesos or $350,000, it is not good. But that is not the point. The point is that there may be services or purchases that do exist, but that they are deficient in providing that they were actually rendered, or that there are technological services that, for example, don't even require human beings to be rendered, but therefore their existence could be questioned. The crime is precisely that there are invoices whose support cannot be proved. And for that, there is a whole questionnaire with more questions, I believe, that if you can answer, then you can rest assured that the tax authority will be okay with your deductions. And we are not pro tax authorities or pro taxpayers. We are pro justice. And we will only say that if they hit the tax authorities and the country very hard with this type of issues, and that the fact that now it's a criminal offense, it opens our eyes and tells us that in real services, a lot of attention should also be paid so that everything is perfectly documented and that the benefits and the effective rendering of the service can be really proved. And a little ahead of what is coming on courses later on, well, I can say that we already have this course in Spanish, which is about materiality of operations. Because there is a very important witch hunt that tax authorities have started, in which it is identifying companies that used to sell invoices and that did not provide materiality in the goods or services they sold. And these companies, after a legal process, go to a blacklist, which is a famous list of Article 69B of the Federal Fiscal Code. If one of your suppliers fell in this list, be careful, because you only have 30 days to go and clarify with the tax authority that your service has materiality. Otherwise, the expense you have made is not deductible, and you will have to recognize those effects, even if it was some years ago, retroactive effects. And quickly, what is the effect of a non-deductible or a deductible item? It is simple. Imagine you have 100 pesos of income and you have no deductions. Then, if the income tax rate is 30%, the income tax is 30 pesos. So the net income of that company will be 70 pesos. But if I have the deductible item of 100 pesos as well, what happens? Let's say that having the same 100 pesos of income, we will not have any tax profit, of course, so our income tax will be zero. Then we could conclude that, a deduction is worth 30% of its value in income tax disbursement, and that is because income tax rate is 30% for corporate legal entities. So for every 100 pesos disbursed, the income tax goes down for 30 pesos, right? It is as simple as that. And going back to deductions, let's talk about one that only applies when we have debt or money, for example, in an account payable or an account receivable, right? Even if we have money in the bank. All legal entities must have balances in the bank, right? This concept can also be income, and we have already explained it. The famous annual adjustment for inflation. A company, for example, owes money without interest, to make it simpler. And a year goes by, and it pays. When it pays the person who lent it, this person will receive the same amount of money it lent a year ago. But let's say there was a 5% inflation, even if we know this year was higher than that. That is, everything became 5% more expensive. In reality, that person who I charge has 5% less purchasing power, and it is neither his fault nor ours. So the law allows that person to deduct 5% of the value of what he or she borrowed, and we accumulate or tax 5% of what we borrowed under the concept of inflationary adjustment. That is the famous annual adjustment for inflation in Mexico. Regarding tax losses, it is very simple there. When your deduction exceeds your income, then we're talking about a tax loss. In this case, if that happens to you, you only have 10 years to use it when your income exceeds your deductions. If you ever heard about people who sold their companies with tax losses, basically what the buyer wants is not to pay income tax in the future by using those losses, right? The problem is that there are a lot of people who, well, the vast majority, that sell the losses, and of course those losses were false. And in a tax authority's review, this was discovered, and now it's prohibited. Actually, there's a blacklist on that also. And one of the main aspects to consider when talking about deductions, how to fund a company, as capital or as debt. Of course, for a foreign group, debt is the logical answer, since interest payments are deductible and withholdings could be as low as 4.9%, while dividends are not deductible and the general withholding rate is 10%. So there's a big difference there. Not deductible and 10% withholding. And this without considering any more beneficial tax rate that a particular international tax treaty could provide, of course. For this reason, there are some restrictions in the deductibility of interest in Mexico that in some cases apply to all debts, related or not. This is important since the OECD always recommend through the Base Erosion and Profit Shifting Program, or the BEPS program, to fight against aggressive tax planning structures that involve only related party transactions and not all the transactions. It is evident that Mexico did not care about this, and you should consider this before investing here. The first limitation is the thin capitalization rule, the 3-to-1 ratio rule, right? In terms of the Mexican income tax law, interest on certain debts contracted with non-resident related parties that exceed 3 times the net shareholder's equity will be treated as non-deductible item, okay? This is the related party limitation. So here it only applies to related parties. In order to compute the amount of the debts that exceed the aforementioned 3-to-1 debt-equity ratio, an amount equal to 3 times the average net shareholder's equity, considering the net shareholder's equity as of the beginning and at the end of the tax year, right, should be subtracted from the average annual balance of the interest-bearing debts. Is that clear? In case the average annual balance of the debts contracted with non-resident related parties is lower than the excess of the debts, then interest arising from debts contracted with non-resident related parties shall be non-deductible. Okay, that's right. On the other hand, if the average annual balance of the debts contracted with non-resident related parties exceeds the debts exceeding the 3-to-1 debt equity ratio, the non-deductible portion of the interest arising from debts contracted with non-resident related parties, I have to say it well, right, shall be calculated by multiplying such aggregate interest with a factor equal to the result of dividing the excess portion of the average annual balance of these debts, right? And that's it. Now let's go to the second limitation, that $20 million or $1 million threshold, $1 million of today. In terms of the Mexican income tax law, interest paid in a given tax year that exceeds 30% of an adjusted net profit that is complex to calculate, but that in summary is something similar to the tax EBITDA, including foreign source interest, shall be non-deductible in proportion of the tax payable. Any amount exceeding that 30% limit may be deducted during the following fiscal years until depleted, provided proper records are kept, of course, of the net interest not yet deducted. Here we could have some problems with the CUFIN calculation since it considers non-deductible items, but that's another story. For such purposes, the first 20 million Mexican pesos, or approximately $1 million up to date, of deductible interest in the tax year shall not be subject to such limit. However, such amount will be compounded and applied to all business entities and permanent establishments that either belong to the same group, okay, or are related parties, taking into account the proportion of accruable interest that was generated during the immediately. Such a limit will not apply to interest arising from debts assumed to finance infrastructure projects construction work located in Mexico, debts assumed to finance oil and hydrocarbon exploitation, extraction, transportation, storage or distribution activities, and generation, transmission, and storage of electricity and water, nor to state-owned productive companies, the old state companies. Now they are productive. Deductions are a bit complex, right? We'll talk about now the obligations that legal entities have in Mexico. There are many, depending on how many operations you do. If you have operations with companies that are part, for example, of the same group or related parties, as they called, if you do operations abroad, for example, in some cases, if you receive cash in certain amounts, among many other assumptions, they range from the so-called informative returns, that must be filled out and sent to the famous tax attribute accounts, for example. The KUCA and the CUFIN accounts. We'll talk about that immediately. As we said, Mexico is a country full of informative returns and where the fiscal compliance is one of the most loaded in the whole world, if not the most. In fact, a few years ago, it became mandatory for companies to submit electronic invoices, for example, or electronic accounting to the Mexican tax authorities on a monthly basis. That is, everything is already super identified and crossed by the tax authority, which has programs such as the Jupiter program, which detects statistical movements that do not match and immediately summons you to clarify the situation. Actually, there were many appointments in pandemic because income of the companies dropped, and I wonder how many silly appointments were made with the same explanation that of the drop of income due to the pandemics. Perhaps a waste of time, right? And from the above, let's recapture two account obligations we already mentioned. The paid-in capital account, or KUCA, which is basically the account through which a control of the capital that each shareholder or partner in a company or corporation contributes, and it should be kept. And of course, in case of a capital reimbursement, those contributions should not be taxed with income tax. That's logical. It is used to keep track of how much capital is contributed, and the good thing is that it allows us to update this by inflation year by year or on a movement basis. So inflation is high. That's a very good thing. The other account is the net after-tax profit accounts, or the CUFIN account, which is the account used to record how much profit has already been subject to income tax and in principle should not be subject to pay again, right? Although there is an additional 10% rate from 2014 and as of today, if the dividends or profits are distributed to individuals or foreigners or non-Mexican residents, which makes the total income tax to be taken out of a company of a 37% effective rate, which is 30%. We have already talked about this. This is a corporate income tax, plus the additional 10%. Believe me, it's 37, not 40. And that's the tax effective rate for a non-resident that is investing in Mexico. A small parenthesis. If the dividend is paid to an individual, when the individual receives it, he or she must accrue it at the rate that applies to him or her. And this is to say the maximum rate of 35%. Let's assume that. But this person can credit the 30% already paid by the company. That's the corporate income tax. And will only be paying this person an additional 5%. This is assuming that this person is, of course, at a 35% rate, I repeat. In this case, the final rate will, instead of 37%, as a foreign non-resident will have, compounded, will be of 42%. In short, for an individual who puts in money and earns 100 pesos through his legal entity or company, in the end, only 58 effective pesos will reach his purse. The rest are taxes. The only thing you need to know for those who start with the tax issue is that the residents abroad who do not do business directly and regularly in our country, when they generate income that has a source of wealth in Mexico, are taxed therein only if such type of income is contemplated expressly by the Mexican income tax law. For example, some types of income are salaries and wages, professional services, real estate, leasing, interest, royalties, disposal of shares, among others. But for example, a type of income that is not taxed, even if obtained from a source of wealth within Mexico, is, for example, the sale of other movable property. That's interesting. So you have to fall in the assumption, specific assumption, in order to be taxed. Generally, the one who pays is the one who withholds, and the withholding rates could be between 4.9%, the lowest in the Mexican income tax law, and even we could go to the 40% depending on the nature of the resident abroad. This, since the resident abroad is not going to come to Mexico and pay the income tax directly in the great majority of the scenarios, right? And let me clarify something. The 40% rate is something special and almost does not apply, but the 35% rate is very common, by the way. And how do we know if the income generated has a source of wealth? Well, we have to go to Title V of the Income Tax Law, and this title establishes the types of income that foreign residents can have, and if they have a source of wealth, the same in cash, in goods, in services, or in credit, and that they fall within the assumption of source of wealth. Each article has its own assumption. There is no general assumption for that. Value-added tax is an indirect tax that seeks to tax consumption and the final consumer. Value-added tax is basically levied on the following acts. 1. The sale of goods. 2. The rendering of independent services. 3. The granting of the temporary use or enjoyment of goods. And 4. The importation of goods or services. When you go to the store and you buy only a lollipop, you basically pay the price plus the 16% VAT. It is included in Mexico, remember that. Note that in border regions the rate could be lower, but we will not go into complexities right now. The 16% rate goes to the store and the store reports it to the Mexican tax authorities. That's how easy and simple it sounds. But why does it become so complex? The store, in order to be able to sell that lollipop, had to buy it from a supplier. So the store bought it, let's say, in 7 pesos plus VAT, and sold it in 10 pesos plus VAT. When the store bought it, it paid 1.12 pesos for having bought it. And when the store sold that product for 10 pesos, it charged an additional 1.6 pesos VAT. Then, when the month is over, the store does the monthly math, and it owes the treasury 1.6 pesos. But since it already paid 1.12 when it bought the lollipop, then it only has to pay to the treasury the difference, which is 48 cents of a peso. That's the part of the profit. So far, everything is clear. And we could say that as long as the crediting requirements of those 1.12 pesos that were paid are complied with, everything is perfect. A parenthesis. The VAT is only on collection. This is to say, on a cash flow basis, or if you fall in any of the collection assumptions of the law, such as debt compensation, payment in kind, etc. It is not the same as in income tax. If you remember, we said that in income tax, you can tax if you issue an invoice, partially charge a price, or deliver the good, or provide the service. In value-added tax, let us keep the idea that it is a collection plus the fulfillment of a series of requirements, among them that the expensive, for example, is deductible for income tax purposes. This is, if I spend something and it is not deductible for income tax purposes, then the value-added tax should never have been credited from my value-added tax payable, right? That is also logical. Going back to the example, why does the exercise become complex? Let's imagine that the store also sells newspapers. It turns out that the sale of newspapers is also exempt from value-added tax. So the law tells me that I have to take a proportion of how many of my sales or activities are taxed and how many are exempt. And whatever I get, that percentage of tax over total sales is a proportion that I can credit, but not all the tax or the value-added tax that I paid. If my proportion in the store is 70% lollipops and 30% newspapers, then out of the 1.12 pesos that I gave in my example, I will only be able to clear 70% of that tax, which is instead of paying 48 cents, I will only be paying 81 cents, which is almost double. Now imagine when the store sells 10,000 lollipops a month, plus chips, plus books, plus vegetables, plus everything else that you could find in the store. You tell me how the Mexican tax authorities review will be in this aspect, and if it's going to be easy to get a refund. That's why I say refunds are very complicated. Well, this is why the reviews are thorough, and there is nothing wrong with that. They're not only going to give away money just like that. Sometimes people get confused taking that 0% rate is the same as exempt, and it is not. The difference is that the 0% rate is taxed at the rate that is 0, and when you have an exempt, it's not taxed. So that proportion becomes like more complex when you think about this. And people get more confused with the issue of importation and exportation. In imports, basically, what you bring into the country is taxed at value tax, and if you don't pay it, it is considered as smuggling, and it could be a crime. And when we talk about services, it's a rare regime because there is a value tax, but you can credit it without the foreigner having to pay it, which is, let us clarify. He's not gonna pay it. So it is a value tax that is called virtual or only manifested in the monthly return, but it is creditable. So there is no cash flow and you can credit tax. Rare. By the way, the value tax returns are mostly monthly and final. They are not provisional payments, but they are reflected as informative data in the annual tax return. And just to be clear, and finish with the export. The exportation is exempt because finally the good that was bought, for example, is not destined to be used in the country, in Mexico. And remember that the value tax only taxes operations that or transactions that occur here within our borders in Mexico. When that good arrives abroad, it is supposed that that good will be taxed with value tax and importation taxes, as the case may be, so international symmetry will be respected. I hope this video gave you a good notion of what is to make a business a little more orderly. And well, it was a lot of information in a short time. But with this, we believe that we can give you a very general overview of how the main taxes work in Mexico and what happens if you want to invest here. We hope it has been useful for you.